everybody. Welcome to the Everyday Real Estate Investor Podcast. I appreciate everyone listening, and we are going to jump right in today and get right to it. There's a lot going on in the real estate world with lending and finance and all of that stuff. It's a moving target these days. So we have back on the show Grant Schroeder with Academy Mortgage, so we can get an expert view on what's going on. What's been changing, why are these things going on, and what to expect moving forward. So Grant, thanks for being here again. Appreciate it.
Thank you for having me, Ben. Wouldn't necessarily consider myself an expert, but always trying to learn and grow and trying to understand what's going on and learn from those with more experience that have gone before me.
Awesome.
So yeah.
Humility too, I like it. Yeah, but you're day to day in the finance world, so I'm on the sales end, I'm on the investment end. People like you, I count on people like you to know. I know it just from what I see, and I'm definitely involved in the finance side too, but you see the behind the scenes stuff. You can kind of see what's coming down the pipeline and have a little bit better understanding of why those things are happening and stuff. So definitely appreciate your insights and everything. So let's get into what's going on right now in the finance world and why are rates so volatile and without telling the ending of the story, but what's going on, why are rates jumping around, and let's just dive into the nitty-gritty of it.
Yeah, I mean, as we kind of talked about on the first podcast, rates are really based in the mortgage-backed securities market, which is a bond market. So it's going to be volatile just like the stock market is day to day, but we've seen a lot of increased volatility the last couple weeks since the consumer price index. It was projected to come out at like 8.1%, and it came out hotter than expected. The core reading was hotter, and the overall reading is at 8.3%. Kind of took bond investors by surprise. Bonds really hate inflation. We've seen a lot of volatility since then. We had the Federal Reserve meeting on Wednesday just this past week, and that's created a lot of volatility. Some of their new policy going forward and some of the statements, things Jerome Powell said or didn't say, are creating a lot of volatility right now with rates. Yeah.
Okay, and let's circle back on. We talked about this a little bit on the first time we had you on the show. People see so they 75 basis point increase to the Fed funds rate, right? Everybody sees that and they're like, oh, that means interest rates are going up, right? So let's talk. Now it could in the end, but let's talk about how that works, because everybody thinks it's a direct relationship, right? Mm-hmm. Like this goes up, so mortgage rates go up. But can you speak a little bit to that and how that kind of works in as layman's terms as we can without getting too deep into the weeds, right?
Yeah. So the Federal Reserve hiked the Fed funds rate by 75 basis points, or 0.75% in rate. So right now their Fed funds rate is between 3 and 3.25 right now on the year. Really, they're hiking the Fed funds rate that's their lever they're pulling to try and curb inflation. That increases the cost of consumer borrowing. The hope is to slow down consumer spending by doing that. The Fed funds rate directly affects your home equity lines of credit, your credit cards, your variable student loans, auto loans. Those are directly affected by that 0.75% increase. Typically, the mortgage-backed securities market, it's more wary of inflation. So when the Federal Reserve is hiking the Fed funds rate, they're doing that to try and curb inflation. And most often what we've seen over the last several months, we get some improvement in rates. Rates go down after a Fed funds rate hike because the bond market and investors like seeing the Fed aggressively trying to attack inflation.
Yep. Okay. So Fed fund rate goes up to fight inflation. Bonds like that, and so mortgage rates can tend to trend down.
Tend to come down.
Okay. So that's the 30,000 foot view of all the minutia of what's going on there. So good. I think that makes sense. So that's, again, I think a lot of people, and I hear it all the time. Fed raised the interest, or raised the rates, so mortgage rates are going up. That's just like they think it's the same thing, and it's not, right? So
it's all over media headlines. It's very much misinformation.
We won't get into that. Yeah, love it. Love the headlines. So if you've seen any of my market update videos, I kind of bash on the headlines a little bit. So awesome. Okay, that's good. So that's kind of where we're at. Is rates are higher, quite a bit higher than they were this spring.
Yeah.
Let's talk about, so what are you seeing? Are you still continuing to see a pretty good flow for like applications? I'll talk to the sales side in a second, but what are you seeing?
We're definitely seeing some good flow on applications. Been a little bit of slowdown in the last couple weeks. I feel very fortunate. I have a great group of realtor referral partners like you and Anita. I work with realtors in other states, but also just past clients that refer by word of mouth. So that has kept me and my team busy. But we've definitely seen a little bit of a slowdown, and those that do get pre-approved, especially with all the news going on right now, they get pre-approved, and yes, your pre-approval is good for 120 days, about 4 months, but a lot of people are pausing and kind of looking around and seeing what the headlines are going, what's happening, and there's kind of this more cautious approach to the velocity of transactions right now. Yeah,
which, not to get too much on a tangent, but that's one of those things that, again, going back to the headlines, and there's often truth within it. You just got to dig for it. But a lot of people read the headlines and then they draw a conclusion that may or may not be fully true, because they're negative headlines. That's what sells, right? And it almost can become a self-fulfilling prophecy, right? Because okay, we're going to hold back and wait, and the more people that hold back and wait, the more we can potentially spiral down and lower activity and all of that stuff. So that said, on the sales side, so probably no refinances either, I'm guessing, or very few.
Cash out for investors. There's still a lot of investors are doing BRRRRs, buy, rehab, rent it out, refinance, repeat, increase the velocity of your money. Still doing lots of those right now. It's still a great strategy to be able to build wealth and pick up a rental, doing value add. But no like your traditional consumer cash out, debt consolidation, refinance. Right. It's more investor cash outs right now.
And that's a good mindset thing to get around, I think, too, with rates. Is it really doesn't matter what the interest rate is if you can create cash flow or create equity using that debt. It really doesn't matter if it's 3% or if it's 8%. Hopefully it doesn't get to 8%. But if you can buy something, add some value, turn around, pull some money out, you're still making the payment with the income that you're getting. What does it matter what the interest rate is? It really doesn't. You got to think long term in those things. So from a sales perspective, definitely slow down. Lots of people that were on the cusp of being able to afford when rates were at 4.5%, 5%, and now we're up in the low sixes for a lot of people, even mid sixes, right? So if you were right on the edge of affording it, you're kind of out of the market at this point. So a lot of those people have fallen off. And then on the flip side, prices have pretty much held steady or continued to creep up a little bit in most sectors. Again, it's all kind of neighborhood by neighborhood, market by market, but so they haven't felt the relief of, okay, well, interest rates are higher, but prices have come down. So that's kind of taken some buyers out of the pool. But you know what? I feel like the market was so crazy 6 months ago. You really had, your rate was lower, but you really had no chances of, as a normal, cash offers were winning a lot of contracts, and you had to write an offer way above list, and you had to go against 10, 12 other offers, and hope, beg to get the property, and give all these concessions and all that. And so now we're back to where you can actually shop and think about it, and maybe sleep on it, and feel like you're not going to miss out on the deal. So I like this market better. I think it's a lot more stable. It was really getting out of control with how far things were getting bid up, and just so many buyers, and there's still a lot of buyers out there, and the inventory is still very low. It's here in Portland, it was actually going up. It was still only 2 months or something like that in July, but it actually came back down in August, 1.8 months. So I was actually really expecting it, because there were more listings, and with a slowdown in sales activity, I was anticipating it would just trend up, and so I was actually a little surprised that it came down. Not a lot, but
there is a little bit of a seasonal aspect. I mean, with listings, with applications. I mean, traditionally real estate is a little bit slower in the winter months. The last 2 years have kind of been an anomaly with rates for refinancing and purchasing. But I totally agree with you. This is a much healthier market for buyers. This is a great. We're still seeing a lot of people create wins and have success because they're taking action. They're not like the last 2 years have been a little bit unhealthy where okay, you have 12, 14 offers and you view it on or hits the market on Thursday, open house Saturday, and you have 10, 12 offers by Sunday and you're just bidding up.
Or they just cancel the open house because what's the point? We already got 3 offers and nobody even looked at it. They just saw it online, right? So yeah.
Exactly. Those are still taking action right now are being rewarded. I mean, I have 2 clients that were looking for homes for 6-7 months and they were losing in those bidding wars, but they each just purchased one a single family residence and one a condo on homes that had sat for 30 to 40 days. Sellers have gotten more accustomed. I mean, that's healthy for days on market.
Yep, absolutely.
But they've gotten more accustomed to their inventory flying off the shelves, and now they're more open to negotiating. Both clients, one got a 5% seller credit, the other got a 3% seller credit.
Wow.
Not only to help them qualify, but to get their monthly payment down. We bought their rate down. They saved, one with the 3% credit was probably $425 a month on a condo. And the other person who was able to get a 5% credit, she saved close to almost $600, $575, $600 in a monthly payment because she was able to take advantage and negotiate with a seller.
There's a great strategy, right? Their interest rates are higher. Okay, well, negotiate a rate buy down, right? That's a great way to do it. Yeah, and that could actually move someone out of affordability and back into it again. Yep, yep, for sure.
Exactly.
Awesome. Let's talk about some of these investor but like more from the owner occupied like house hacking strategy perspective. You've got a couple. I think we talked about at least one of them a little bit on the last one, but you've got a couple really cool products for people looking at, hey, interest rates are a little higher. Why don't I look at buying something with another living space? I can rent that out and offset it, and now it works again for me, right? So let's talk about a couple products that could work really well that you have available.
Yeah, definitely our 2 most active groups of buyers right now are investors and house hackers that are still taking action in this market. They're not being swayed by headlines. They're seeing the opportunity. I mean, you have your traditional loan solutions. We have several clients that are under contract right now using VA or FHA financing for 2 to 4 unit multifamily. But one of the loan products that we recently had come back online is called Home Possible. It's a conventional loan solution with 5% down for a 1 up to a 4 unit property. I mean, if you're buying a 1 unit as a first time home buyer, you can still put as little as 3% down, and Academy has 0 down first time home buyer products. But especially for someone looking to house hack, maybe a seller doesn't want FHA financing, or there's something in the appraisal, the condition of the property that might not work for an FHA appraisal because it is a little more picky than conventional. Someone can utilize 5% down conventional to buy a 2 up to a 4 unit property, where your traditional conventional solution in the past has been 15% down owner occupied on a duplex and 20% down owner occupied for that triplex or quad. So
big difference in down payment.
And your mortgage insurance too. Because FHA has a fixed 0.85%. If someone has good credit conventional, they're seeing 0.3 to 0.4%, and their MI, part of their monthly payment, is half of what it would be FHA.
And our rates relatively comparable?
Rates are pretty comparable, maybe just slightly high, a little bit above FHA.
Okay.
Typically your FHA VA loan programs are more government backed. They are going to be 0.25% or so below conventional rates traditionally.
Okay. Yeah, and that you alluded to it a little bit. And I wasn't even aware of this till a few years ago, but with a 3 to 4 unit FHA loan, so it's you look at your normal conventional, and you mentioned a 3 to 4 unit 20% down, right? Well, you can buy that owner occupied FHA with 3.5% down, but there's overlays in that basically almost never work, at least around here. That it has to meet a self-sufficiency test. It really doesn't matter. Like basically the unit has to cover, like the income has to cover itself, like essentially. Correct. Right? And
so if someone is buying a quad, basically the rent from the other 3 units has to cover the PITI, their total monthly payment for their mortgage.
Right, regardless of the income that they're bringing to the table.
Correct.
Right?
So someone could have great credit, they could completely debt to income ratio qualify, they make a lot of income, that's not an issue. But if the property, because it makes it very property specific.
Yes.
If there's a landlord, a tired landlord that's selling is kept below market rents, okay, that self-sufficiency test, you're looking at those leases, and if that doesn't cover the mortgage, then that property doesn't qualify for.
And they could have
for
plenty of
FHA
income
financing.
that's like, well, it doesn't matter. Like it's got it. Yep. And it's really at the discretion of the appraiser. So you don't know until you get to that step. You're pretty invested in the deal at this point. So with this product, really close to the down payment, same down, 5% instead of 3.5%. And you don't have to worry about any of that stuff. You can get into a 3 or 4 unit property, owner occupied. And
if you qualify it for it, debt to income ratio wise, you don't have to worry about, okay, 2-3 weeks in, get the appraisal back, market rents doesn't line up.
And you can still use the income of the other units to qualify. Yeah. Yep. Awesome. Yeah, that's a great product. You also mentioned, so depending on what market you're in, may or may not be a big thing. Here in Portland, accessory dwelling units are a big deal. So there's a few markets across the country that's the case, but some people might be like, what is an AD, accessory dwelling unit? I don't know what that is. So you have one that you mentioned something a few weeks ago where something changed with that as well.
We recently had a conventional loan solution that came on board for that recently. I mean, it's typically ADU. You look at markets like San Diego, Portland, Seattle. I mean, down in Arizona, I think they call it a casita.
Nice,
but,
I like that.
But it allows someone, so where traditionally, well, to back up, typically, okay, single family residence, especially someone who's married but still wants to house hack. I know when I did my first house hack, I was single. It was okay, I could buy a single family residence, rent out rooms. When I got married, my wife Samantha we still wanted a house hack and still take advantage of that. But we bought a duplex and rented out the other side, so we had our own separate space. Yeah. Some people don't necessarily like sharing an attached wall, so buying a property with an ADU is an opportunity to still house hack, but have your fully separate space. Now, traditionally, the last several years, when you're buying single-family residence plus an ADU, zoning in a lot of these bigger municipalities allow for that to have that additional dwelling unit. The lending world typically looks at that as a duplex when you have 2 units. So the default was FHA financing, where to be able to use rents from the other unit, but you still have to jump through all the hoops with FHA. FHA is an awesome loan product, but now we have 5% down conventional, be able to use that income and similar to Home Possible, but specifically for an ADU.
It's about time, by the way. I mean, geez.
I mean, you think with all the changes with zoning code and planning departments, it should have happened 2 years ago. But
yeah, it takes a while for lending to catch up sometimes. So
it does.
But yeah, that's a great one. Yeah, and so if anybody doesn't know what an ADU is, just a quick definition. Basically, a secondary residence, separate, or it could be a basement, or it could be within the dwelling, but a lot of times it's detached as well. That's like it's subservient to the main home. It's usually smaller because code requires that, so 40 to 50%, or it can be smaller. But yeah, you've got your main home, and then you've got your smaller secondary dwelling that's on the same property, but it's not like a duplex where a lot of times it's attached or it's similar in size. Things like that. There's some different nuances with it.
And another part of that, a lot of people, it's very hard to find ADU financing. A lot of people are using cash or a home equity line of credit or a hard money loan to build it, and then it can be hard in that instance to refinance it and lump it in with your existing mortgage, so you're not having 2 liens on the property. But with our ADU solution, you can go up to 95% loan to value, just like you're putting 5% down a purchase, but you can wrap your if you did ADU financing, you have an existing ADU, you added to your home in the last several years, you can wrap that in, and it's, even though technically it is a cash out refinance because you're paying off that second loan, for this ADU loan solution, it's treated as a rate and term refinance, and you can lump that into just one loan and pay off maybe a higher interest bearing loan that you use to construct your ADU.
Yeah, nice. So, very cool. Awesome. Let's jump into like investor specific stuff. What's changed there? Again, in the first time we had here, we got into some nuances of that. So you can go back and listen to that, or just connect with Grant, and he'll get into the weeds on that stuff with you. But just kind of a quick overview on investor loans. you're not occupying, you're buying it strictly as an investment. What are some solutions that you have right now, and has anything changed since we had you on last time?
Nothing really has changed. I mean, rates have ticked up just slightly on it, but we're still seeing a lot of activity with investors. 10% down, no mortgage insurance on a 1 up to a 4 unit property, non-owner occupied. It's just underwritten like a conventional loan. So I mean, the appraisal is conventional. When your realtor, your broker's writing up your offer, it's conventional to a seller. It's something that Academy keeps on our own books. It's specific to Academy, where traditionally you're 20% down on a 1 unit or 25% down on a 2 to 4 unit investment property for a conventional loan. So that's a good alternative. And then one of the things we've been seeing a lot when properties have been sitting, a conventional investment loan, you can only get a 2% seller credit to cover closing costs and points and whatnot. With our Academy Investor Loan, you can get up to a 3% credit to cover basically everything in your closing costs. So almost come out of pocket just your 10% down for a property.
Nice. And what are rates like,
probably
range wise? What are we looking at? And compared to like your outside of Academy conventional products.
So FHA VA is probably high 5s, low 6s, probably right around 6.125%. Conventional for a primary, you're looking high 6s right now, 6.5 to 6.75. For a traditional investment loan with like Fannie Freddie conventional loan, you're looking low to mid 7s. With our Academy Investor Loan, you're probably still low 7s, like 7 to 7.25.
Okay.
Typically, we're about 3/8 to 0.5% better than wherever conventional is, even with 20 to 25 down versus 10%.
So a little bit better rate and a lower down payment.
The thing that's becoming a little more interesting in the lending world, and we talked about this before, a lot of times rates are determined by the mortgage-backed security, by secondary investors' appetite for different rates. And sometimes you get into periods where you're having a spike in rates like we are right now, or this extended period of time where most of the time secondary investors are making their money on the interest paid on your mortgage. But when they're fearing, okay, this is a spike, they're going to get refinanced in a year or two, rates come back down to the 5s, maybe even into the 4s, they're worried about not getting the interest on that loan. So sometimes you see on rate sheets come through from different secondary investors, they are not offering higher rates. They are just increasing their points and their cost up front, whether it's a primary or it's an investment, especially with your conventional loans, where that's the nice thing with our Academy Investor Loan. It's not tied to the secondary market, so we don't see that. But you see these investors on a conventional loan stacking points, so they're getting their money up front.
Yeah.
Because they know they're going to get refinanced in a year or two.
They're protecting their yield, yeah. Which is an interesting, so I guess the minutia that I'm not 100% sure of, but I do know that back before the financial crisis, now they didn't foresee the financial crisis coming, but prepayments were a lot more common. And that was your yield protection, was your prepayment penalty. Okay, well, we might get refinanced out, but that's fine. If we do, we're going to get a big fee. And so they're protecting their yield. So now they're just pricing it in up front instead of doing that.
And prepayment penalties are not allowed on qualified mortgages.
Right. So that's changed. Changed. So they based, that was so like, they can't do that anymore.
That's
right?
The points are
so that's their way to do it. That's the way to do it, is that we still got to protect our yield, so we can't do a prepayment penalty to do that. So now they're just adding additional fees in, and that's a good observation, a good point, because at a certain point you can keep increasing rates, but then you're not protecting your yield, because you're just increasing your likelihood that you're going to get refinanced out sooner, right? Because and is that a little foreshadowing there? That that if they're doing that, then obviously they're thinking
that this is temporary.
Yeah. So that's I didn't want anybody to miss that. So they're doing that. So obviously they're thinking, they don't know, but they're thinking, they're aware of it, that this is probably temporary. So hey, we got to protect ourselves on this loan so we're not losing money, right?
Yeah. And we talked about this on our first podcast, where typically with whether it's conventional FHA VA for a primary residence purchase, you have a par rate, a no cost rate on a lender's rate sheet. And many of your lenders, your Quickens of the world, your online lenders will throw out low shiny rates and attach a bunch of points to them, and not show you what you're buying down to get that nice shiny rate. And I always like to start with, okay, here's the par, no cost rate. If you want to buy down, hey, here are your options. A lot of times I'll just do a screen share with a client and say, hey, here's what the rate sheet looks like. Here are your options. Mm-hmm. And right now, in many instances, we're not seeing a par rate because of that phenomenon we just talked about, where investors are starting to stack points and not raise higher rates.
Okay. Yeah. And that's always something that I tell people when I'm working with buyers is, hey, don't just look at the rate. There's a little asterisk next to the rate for a reason, right? Yeah. So if someone at a different lender is the same loan program is over here, but they're giving you a different rate, you're probably paying for that rate, right? So, but a lot of buyers don't know. Well, this they said they can do it for less. Well, yeah, they can, but you're paying for it. Although there are some times when lenders can give credits and things like that too. So, but it's just always a question to ask. Yeah. Make sure you're looking at the bottom line. What are your fees? Is your net out of pocket more to get that rate, or is it actually, are you getting an actual lower rate from the lender? So let's talk a little bit about ARM loans now, because a little bit of PTSD for a lot of people, right, from the financial crisis. ARM loans were a big part of what made that worse. And so you even throw that out there, and you get a lot of well, hold on, no, I don't want to do that, right? What do you mean? Oh crap, ARM loans are back. Here we go again. What's your take on that? And let's dive into that and some of the nuances of why would they not just get rid of ARM loans? Isn't that what was the issue last time, or what it didn't help, right? So what does that look like?
Yeah, there's a lot of PTSD around the term ARM loan. A lot of times what you saw...
Adjustable rate mortgage, no investor left behind, so...
Yeah, adjustable rate mortgage, where a lot of times you have a fixed period, and then your rate becomes variable. And most of the time there are caps, and so whether it's a 6-month or an annual adjustment period, that will be laid out in the ARM. But every adjustment period there are caps, like it can't go up more than 2% in a year. A lifetime cap, it can't go up more than 5% in a year, something like that. Different times in the market, ARMs are very applicable. A lot of people have that fear of them because you had these hybrid or 1, 2, 3 year ARMs where you had like a intro teaser rate for someone to qualify for 6 months to a year, and then it just jumped up all at the same time and people couldn't afford it.
And they only qualified based on the teaser rate.
Exactly.
Right? Yeah.
And thankfully the lending world our guidelines are stricter than they've ever been. That is one of the reasons why the housing market is still so healthy. It's because we had a credit expansion in 05, 06, 07, 08, and the lending world has been very meticulous in guidelines and underwriting and offsetting risk. So most of the time what you see with ARMs, when you see a spike like we have in rates, it's a good time where, an ARM might be high 4s, low 5s right now, where, say conventional is mid 6s on a 30-year fixed. Most of the ARMs you see out there are 5, 7, and 10-year ARMs. So that means for 10-year ARM, for instance, your rates, so say you're at 5%, that is fixed for 10 years. So you have 10 years if rates drop to refinance. There's no prepayment penalties on it, but you're getting a lower rate, having a lower payment for 10 years, and then it becomes variable after year 10.
Yep.
You have a longer time horizon where you're not getting trapped in this 1, 2, 3 year hybrid type ARM that was gave it the bad name in 06, 07, 08.
So much longer term gives a lot more runway for a market cycle and for interest rates to adjust. So you get a benefit of a lower rate now. You're taking a little bit of a risk of it adjusting, but it's not for quite some time. 10 years is a long ways for you to build some equity and for interest rates to come back down, into where you can refinance back into a fixed rate. Yeah. So very different from what it was, back before the financial crisis. There's been some adjustments, no pun intended, to the adjustable rate mortgage world. So yeah. And so when I did a bunch of manufactured homes, there was a lender that did a step-up rate program, step rate. And even that, people would be like, no, it needs to be fixed. And I had to explain it to them that it was no, it is fixed. It's just fixed for the first 5 years at a lower rate. And then it's fixed at this rate for the rest of the term, right?
Mm-hmm.
But even that was just like, well, no, but it changes. Well, okay, but it's still fixed, right? So
Mm-hmm.
it's just trying to get people to understand that it's okay to get a little creative,
Mm-hmm.
just understand your loan terms.
Yeah.
Um,
There's a fixed period versus like you have your HELOC. A lot of people use that or have pulled from that. Okay, the Fed funds rate went up 0.75%.
A little bit
Within a couple weeks, your bank's going to, your variable rate, if you have an outstanding balance and you're accruing interest daily, okay, your rate just went up 0.75%.
Yep, exactly, which is why typically, if you can, if you're going to pull equity out of a property, I'm always a proponent of fixed rate products. Personally, like I know people love HELOCs and whatever lines of credit and all that because I'm not paying interest when I'm not using it, and I totally get that, but you got to weigh that against situations like this where rates are climbing and now your payment went up 50, 60, 70%, something like that. So if you were cash flowing the property, you might not be now, right? So yeah,
I mean, HELOCs are good. I mean, it's a good safety net having your back pocket beyond liquid funds for reserves with your rental properties. I mean, a lot of times a HELOC is best used for short-term money, whether you are flipping or you're burring, where you're going to be refinancing or selling that property quickly and replenishing that money. So it helps you increase the velocity of money. But if you're going to take a HELOC out,
and to sit on it,
depending on the time frame or depending on the situation, it still can be good. But most time, if you're going to go buy, say, an investment property and put a down payment, you're best off to do a cash out refinance, get a fixed payment on that, and use that as your down payment because that's sitting there, and you're not going to, unless you're doing cash out 6 months to a year, you're not getting those funds back to replenish that HELOC.
Yeah, very good point. So like if you're buying something long term, probably better to do something fixed because you know what your debt looks like. It's fixed. It's not going to change. Whereas you add risk if you have something variable. If you're holding, you're taking equity from here, you're buying something else over here. You can predict whether it's going to cash flow or not, but on a fixed, but not on a variable. But it's something short term. Even if it changes a little bit, if you're doing something else, you're refinancing or selling or something like that, and you're going to pay it back. Less risk on that. Yeah, very very good point.
Some banks and credit unions, I've done a couple HELOCs in my life. One bank had the option to pull out money. You had to pull out a certain amount. You could do it at a fixed amount with a 5-10 year repayment on it, but it was typically higher, like a % or two higher than where the variable was. Most HELOCs don't have that, but if that's your source of funds to continue building wealth through real estate, and you have a deal or something you can add value to, if you have an option to lock a fixed rate on a HELOC, that can be a good use of it.
Yep. Yeah, there are a couple banks and lenders that I know that do have, you can do like even a couple different like chunks fixed or whatever. So it's so just know your loan terms, right?
Yeah.
There you go. Where do you see us going from here? We were talking a little bit beforehand about some of the predictions for inflation, and obviously that affects what the Fed does to the Fed funds rate. Where do we see things going? And then of course inflation. What does inflation affect asset prices generally, right? Too much for probably right now because you got inflation propping up asset prices, but then you've got affordability potentially pushing the other way. So opposite forces. Which one's going to win? Hopefully they just hold each other steady at least. But
I mean, we're not like you said. Inventories dropped to 1.8. We're still seeing demand out there from buyers. We're just not getting as much supply on the market. I mean, people talk about kind of a potential lockdown effect if we have sustained high interest rates. You have all these people that have refinanced to 2 to 3.5%. They don't want to give that up and go buy with high 5s, low 6 interest rate.
Which is so interesting, not to get into so it's funny to me, there's always a reason not to sell, right? So before it was like, well, I would like to sell and do whatever, move up, trade down, move out, whatever it is. But I'm not going to be able to buy anything because I'm going to be going against all these other buyers, and so I can sell, no problem. I'll sell it the first weekend, but then what do I do?
Yeah.
So you have that, and now you have another reason It's like, well, but now I gotta pay this way higher interest rate, or I was already locked in here, so I'd like to move up, but I'm at 3% and I'm gonna be at 6.5. Like, I don't want to do that. So I just think it's interesting. There's always some sort of pullback and hesitation, other than like in an equilibrium market with steady interest rates, which we haven't had for a long time. There's always like this hesitation to come to the market because there's always a reason not to, right? So I just think that's
because we had stability in 20 and 21 because the Federal Reserve was kind of keeping rates artificially low, buying mortgage-backed security.
Yeah.
I mean, you had high 2s, low 3s. People got very comfortable with that for an extended period of time, but you had all the competition, all the volatility in the housing market pushing prices higher, okay, now rates have jumped up significantly, and there's not as much competition, but another reason not to sell, not to buy. There's always something keeping it that can keep people from taking action.
Exactly. Yep. Yeah, and another thing that I always point to as far as like the overall, financial crisis versus now. I mean, we were talking about inventory. I mean, we were way oversupplied, during the financial crisis. Just so much new construction, so many houses, and then we had that slew of foreclosures, and it just like was this downward spiral. And we're so far behind. And again, every market's different, but we're still way behind, like 5 million housing units behind nationally on our housing supply. Builders are a little bit nervous.
They're much more reactive after some overbuilt in 06, 07.
Exactly. So they started being really cautious pretty quick as things. So that is going to continue to stifle supply as well. If builders are we're gonna hold off. Let's finish this phase, but let's hold off on this. They can hold land. They don't need to build it out. Yeah. Especially a lot of the big national builders, right? So, that's going to be another pressure on pricing, continue to hold steady, or continue to increase because, supply and demand is not everything. Obviously, affordability, I think affordability and interest rates and that's the biggest factor, downward pressure factor on pricing. For sure, and where that balance is, I don't know. Well, I guess maybe we'll find out. But everything else seems to be pushing the opposite way.
Yeah, I mean, in the housing crash, the Great Financial Crisis, you had 8-10 months supply. I think we got up to 14-15 months in the Portland Metro.
Yeah, it was a lot,
and we're at 1.8 right now.
Yeah.
We have a housing shortage. We have a housing issue, and right now, investors are really I'm listening to a lot of seasoned investors, and I'm working with a lot of investors where they are very excited about this time. Like, they feel like we're going to look back mid next year at this time period and go, this was the golden period, because as the economy enters into recession, whether that's end of Q4 this year or Q1, Q2, as kind of jobs start to turn and the unemployment rate changes, they're kind of looking at this as an opportunity. You're getting to negotiate with sellers. You're not facing competition, but if you get rates come back down, it becomes more affordable for people. You're going to get this rush to the market again. But still, like we're seeing in the Portland Metro, our inventory is not building.
Yeah.
And because permits are down, housing starts are down, builders are, like you said, very apprehensive right now. But we are underbuilt for the last decade.
Yeah.
And that is going to continue. No matter what rates do, the supply and demand is going to be the driving metric on how much how local housing markets correct versus which ones continue to expand and grow. We're very well positioned in Portland Metro compared to a lot of other national markets, but that is going to be the driving factor. That's the kind of the concern. Investors are trying to get in now, but you see, rates, like I was saying, rates come back down, buyers jump back in. We're back to bidding wars.
Yeah. Yep.
So and we like kind of this, like you said, we like this healthy housing market where buyers have a chance, they can negotiate, things are more balanced, sellers don't hold
all the
cards.
And all your cards. Yeah. All your cards and all their cards, right? Yeah.
Yeah.
Oh, man. Yeah. Yeah, it was rough as a buyer. Yeah, I agree. I mean, again, you're paying a little bit more. We talked about it earlier. Projections are that it's temporary. Buy now before you're going to pay a little bit more now on an interest rate, but probably prices are going to continue to go up, and you can refinance down the road when rates come back down. So
if you love a home as a home buyer, or if you're house hacking and the numbers make sense to offset your current housing payment, what you're paying in rent, you're building equity in your own place, or you're an investor and the numbers work even at a higher rate, there will be an opportunity to refinance at a later date.
Yeah, absolutely. And to touch kind of on that too, like thinking for the long term, right? Where, okay, even if the market did pull back, what is, okay, it's probably not going to pull back like it did, 40-50% in some markets in the financial crisis, right? There are definitely projections out there, depending on the market, that say, 10 to 15%, maybe a little more depending on the market. Again, you can't say that across the board nationally by any means, because every market's going to be, some markets are going to drop back.
A lot of stats get boiled down to national, and everything
it's just
is
not
very local.
accurate, right? Yeah, it's extremely local. I mean, and I gave an example of that in one of my market updates too, where even here in Portland, like from a rents perspective, there were sectors that went down over the last year to date. Not very much, but they did.
Yeah.
And then there were other sectors in the Portland metro that were up 22% year over year for rent. So you got to really look at your local market. But my point was going to be is even if it did come down a little bit, okay, you can't time the market. Okay, don't try to time the market. You got to be thinking big picture and think long term, because what if you're wrong? And it doesn't, and it keeps going up. Well, now you missed out. Well, what if you're right and it does dip and you bought? Okay, well, if it's an investment and it's covering, so what? It'll come back, right? If it's your personal residence and you're going to live there for a while, so what? You're not selling. So as long as you are comfortable in your home, or it's a long-term investment that the debt's covered by your income, price only matters if you choose to sell again, right? Or if you want to get to the equity for something else. But it's only one piece. It's only one piece of the puzzle, I guess. Is my point, right? There's so many. You got to consider all the factors, not just like, will prices come up or are they going to go down? You got to look at, if it's your residence, am I going to enjoy this? Is this where I want to live for a long time? You're going to be paying the loan down in the meantime? Same thing on the investment side. You're getting income. You're controlling an asset. So there's other factors other than just price.
And the housing supply, the housing shortage doesn't just affect home buyers, it affects renters too. I mean, how much we've seen in rent growth in the Portland metro. What is it? The landlords are allowed to raise rent like 14.6%.
Yeah, by the way, for anybody that's like, oh my gosh, Oregon has rent control. Yeah, you can still raise it almost 15% this year. So that's a lot. Yeah. That's quite a bit. So I don't know. Not to get on a tangent on that. I'm not a big fan of legislation and over legislation, but it's not that bad, in my opinion. Hopefully they don't hear that. But don't do more. Don't do more, Oregon.
But renters get affected by that too.
Absolutely.
If you're buying a property as a house hacker, as a duplex, or a multifamily property, you're an investor. Like, if the numbers work now, okay, you're not banking on appreciation. You're not banking on rents going up. But that housing shortage is going to affect home buyers and investors. It's also affecting your renters and your ability to raise rents over time. So.
Yep. Absolutely. Yep.
Did you want me to circle back at all to inflation and the Fed? I don't know if we touched on that.
We were, I think, trying to go there, and then I probably went off on a tangent like I do. So let's circle back to that before we sign off. Absolutely.
Yeah. So CPI came out hotter than was expected. We talked about that a little bit, and that is really going to be the primary driver of rates going forward. The Federal Reserve had a lot of commentary about the Fed funds rate, what they're going to do with their balance sheet, and really going forward. It's going to be very interesting to see these next couple months. We certainly think the inflation will be coming down, because we're also, even if we're only increasing, say, a tenth or 0.2% month over month from September to October, October to November, we're replacing fairly high readings from last year. So like our overall numbers will be going down. It's definitely going to be a very interesting winter, but right now it's still a very good opportunity to buy. Like I said, we're seeing investors taking action. Most of the properties that I've bought in my my short period as a homeowner and a real estate investor have been between October and February, because it's a naturally slow time in the market. There's more, and even now more than ever, there's more opportunities to jump in and take action.
Absolutely. Good deal. Well, awesome. Well, thanks again for being. We're gonna probably make this fairly regular, because I mean, especially right now, you know, things are changing. You guys are always bringing on new products and stuff too. But yeah, we're kind of in this crazy, like, where are things going world. So we don't want to go too far in between. So because we want to make sure people are up to date on what's going on in the lending world. So we'll have you on a regular basis. Obviously, people can reach out to you in the meantime if they have questions specifically, or if they want to talk to you about some of these loan products. Again, you do work in quite a number of states. We'll make sure to put your contact information, you can also go back and listen to the last one if you didn't hear that one where Grant was on the first time. We'll include your contact information so people can reach out to you and ask you about some of the products, and I'm sure you'd be happy to help them.
That sounds like a plan.
Awesome.
Always a pleasure talking with you, Ben.
All right, thanks again for being here.